All right, everyone. I think if you can get back to your seatings, we can proceed with the last session here. I'll just maybe give it a few seconds. Otherwise, we'll probably get started. Attention, attention. If you can please return back to your seats. So I'm not going to take a lot of time. I promise. I'm not going to hold you hostage. If you want, please grab another cookie or I don't know if there are any more left. But hopefully something light here for us to conclude. And essentially, we'll just be going over trouble-free financial reporting. So we'll be kind of going over what are the common errors that the GFOA have identified. And also as us, as the auditors, we often see in the financial statements as part of our review. So let's get started. Just going over some universal errors that we see throughout the report. So old terminology being used. So net pension obligation used to be what was under GASB 27, I believe, and net other post-employment benefits obligation was under GASB 45. That's how old I am. But that's no longer used. Now we refer to net pension liability and net OPEB liability. Net assets. So there's no longer net assets. It's referred to as net position. Net assets is referred in one disclosure, and that's the disclosure for deferred outflows and inflows, just because of the definition of what a deferred outflow or inflow is. Otherwise, there should be no presentation of net assets. Invested in capital assets, net of related debt is old. Fixed assets is an old term. We now refer to it as capital assets. Agency funds is old. Expenditure should only be used when discussing governmental funds. Otherwise, we use expense for all the other funds, governmental activities and business type activities. And then amounts not agreeing throughout the report. And this is common because you may have last minute adjustment entries. And so you may have adjusted the financial statements, but you forgot to update the MD&A, or you may have forgotten to update the statistical section. That's something that you need that final review to check all the numbers to make sure everything is consistent. Right. Just looking at the transmittal letter and the MD&A, I know Ahmed covered the MD&A a lot, so I'm not going to spend too much time on that. Maybe just give you some tips. Transmittal letter have an incorrect date. So the transmittal letter should be dated the same as the auditor's report or after. It can't be dated prior to the auditor's report. Redundant information, missing management responsibility for the ACFR, budget information, expected long-term benefits of tax abatements. That's a new addition that you may be missing. Not that new, but relatively new. Going over the MD&A, so condensed comparative financial statement information is needed. This should be on the government-wide financial statements. You need at least 2 years, unless you have comparative financial statements, then you need 3 years of information. And as Matt mentioned, missing analysis, is more what rather than why. And this is other information that's been missing, other like financial position, results of operations, balances and transactions of individual funds, budget discussion of the general fund. These are omitted items. And analysis, again, is the underlying reasons for the change. The reason why I have this in red is because I think the GFOA have indicated in the past that they would consider this as more of a significant comment rather than a general comment where they may state that if not corrected, then they're going to make it a bigger deal, which they've not really made it a big deal. I think with GASB 103, that would be a good time to do a good refresh and just start your MD&A again and make sure you're covering everything. you want to consider not just stating dollars and percentages, but stating the why. Missing discussion of fluctuations in major funds. So if you have a new major fund, you need to consider including analysis about that fund as well. Don't just look at the general fund and then forget about your gas tax fund or capital project fund or housing fund. That also requires some analysis, right? Um, this is a nice chart I stole or borrowed from Michel Marc Levin from the GFOA. And essentially, it's just saying like, all right, well, we need to discuss the increase in net position. So you can look at, what happened to revenues, what happened in expenses. Within that, you can then further break it down into types of revenues or types of expenses or departments. Then you can look at further into different subcategories, which will then kind of help you build that analysis and have something meaningful. Of course, you want to also use materiality here, where you don't discuss every single dollar that went up or down. You want to focus on the significant items. You may want to start with a long list and then kind of reduce that list. As Med mentioned, you don't want to have an MD&A that's 40 or 50 pages long as well. You just want to have a document that council members can read or other end users can read and just get an idea of, okay, this is what happened during the year and this is what's going on with the city. All right. Just some tips which I got from one of our colleagues. So they recommended that you have a folder, on your desktop or somewhere, just for your MD&A. So throughout the year, you know, you have your financial updates that you need to prepare. You have significant staff reports that you prepare for council. Anything that you know it's going to have an impact on the numbers, just toss it in that folder. Maybe label it nicely so you understand what it is. And then, when you're going to go and prepare your MD&A, it's a folder that you can kind of have all your documents there. You don't need to do a lot of digging through the numbers. You can kind of take a different approach and go from the events down to analyzing the numbers. Okay. Other errors are not directing the reader to the notes. So for your capital assets disclosure and your long-term liabilities, I guess not disclosure, for the discussion in the MD&A, you need to have a reference to the notes. So that just needs a small little blurb to add to your MD&A. Also, special or I guess maybe not in the future, but special or extraordinary items requires a reference to the note. Also, when you have restatements, that requires a reference to the note. Um, Also, not including currently known facts, decisions, conditions impacting financial position and results of operation. Right. Moving on to the financial statements. So these are common errors that are identified throughout the financial statements. So nothing specific to a fund type or notes. So interfund transfers not netting to zero. And that can happen for many reasons. For example, if you have a transfer from the successor agency, private purpose trust fund, if you have one of those funds and there's a transfer from that fund to the general fund, uh, these transfers from the fiduciary funds are not part of your interfunds transfers that are presented in the financial statements. So you wouldn't necessarily see that net to zero. That would require reclassification of the transfers to a revenue or expenditure or expense. Essentially, those are treated as outside external transfers. So even though you're recording them within the general ledger, the way the financial statements are presented, those transfers are actually made to external parties, so to speak. So you treat those as revenues or expenditures. just miscategorization of certain types of revenues. Not all taxes are reported as tax revenues. You may have certain types of shared governmental revenues. Those are intergovernmental aid. So those shouldn't be reported as tax revenues. Okay. So tax revenue is something that's your own source, something that the city or your government have levied, versus a shared revenue where you get a share of the pie. Okay. Again, it's probably like ancient at this point, but there is a white paper that kind of classifies common at that time revenues and kind of categorizes them where they should be reported in fund financials and also on the government-wide financial statements. So it's a helpful tool to kind of go through, and that's something that's accessible to everybody. So I have here just a few slides on the recently adopted new pronouncements. So we have GASB 100 that we adopted just this last year. And a common error is the incorrect presentation for restatements. So GASB 100 addresses what to do when we have a prior period correction and we have a restatement. This would be incorrect under GASB 100. So this is no longer permitted. So you're not allowed to just say fund balance beginning as restated and have the new beginning fund balance over here. This won't be permitted. Also, mislabeling as prior period adjustment. So this prior period adjustment that's disclosed here, this is not appropriate. It would have to be called restatements is the correct labeling of this line item. But you can see it's almost correct because it have the beginning of year as it was previously reported, and then we have our restatement, and then we have our beginning year as restated. So it's almost correct, just that the wording is wrong. All right, and this is something that's correct. So this is what how it should look like. So you can see here you have the different restatements. You don't necessarily need to break them down by type and by detail as it's presented here. One thing I would add, this is just from the GFOA's example, but one thing I believe that we need to add for this year under the implementation guide is a line item here for aggregate restatements. If they're kind of trying to be very precise with the wording in GASB 100, which says that you need to have a line item that says aggregate restatement. So you do need, if you do break down your restatements or adjustments in this detail, you do need to have a total for all the restatements for each fund or reporting unit. All right, another issue that GASB 100 created is something that they refer to as ghost columns. Interesting. This happens when you have a change in major funds. So last year you reported a fund as major. This year it doesn't meet the requirements of GASB 34 to be reported as major fund. So it creates a bit of an issue. And you'll see here what happens is that you still need to report the fund balance as previously presented. So you can see that there is a beginning balance that was presented last year. And because it's no longer presented as a major fund, there's an adjustment here. And then the fund balance as adjusted is 0. And you can make the argument, well, it's not really 0. And that's true. It just moves from one reporting column to another reporting column. So it's a bit of a unique thing, but it can probably answer questions if you have those suspicious people in your public that have suspicions of your reporting and what happened to this fund. It was there last time, and you just hid the money or took it away. It's a bit more transparent as to what's going on with the financial statements. All right. It's a bit of an English issue. I'm not sure if that's a big deal, but they did make some point out some difference between the what's a leased asset versus what's a lease asset. So a leased asset are assets that you've leased out. So those are um, essentially your capital assets that will be reported by you, but are going to be reported as an intangible asset by a lessee. Um, they are going to be reported with your capital assets if you're the lessor. If you're a lessee, then you would report a lease asset, and this is your right to use a leased asset, um, and it's essentially a capital asset of the lessee. And these are supposed to be reported with capital assets. I think that's another presentation issue they identified. So lease assets, subscription-based IT arrangements, SPIDAs, public-private or public-public partnership assets are intangible assets. They should be reported with capital assets. Okay, so this would be an incorrect presentation. So you can see here they found that sometimes the right to use is reported separately from capital assets. This is incorrect. Similarly here, you can see this is incorrect. This is the correct presentation, is that you can either combine it with your capital assets, so as long as they're reported in the subtotals, or if you have a more detailed presentation, then they would be included under this subheadings. Okay. So don't present them separately. You may use different reports to gather this information. You may use debt book, or you may have other schedules, for example, but at the end of the day, they are capital assets and they need to be consolidated and reported as such. Right? And then this is an example of the roll forward schedule as correctly presented. So you would have your lease assets, speed asset, and also under accumulated depreciation, amortization. This will be presented under capital assets. Okay. All right. In other reporting for the lessor, you have a lease receivable. You should have a deferred inflow of resource. And with regards to the asset, the capital assets that being leased, this would be reported with capital assets at historical cost. So nothing really changes. So if you have a building that you're leasing out, you just report the building as it's your capital asset. There's nothing else to disclose or report separately. Okay, so not a lot of items there. Moving on to the government-wide financial statements, and this also applies to your proprietary funds. In terms of the net investment in capital assets calculation, there are often errors here that the GFOA have found. And this one can be kind of confusing how it could possibly happen, but incorrect reporting unit amounts used. And thinking about it, I can see it happen for the government-wide, for the governmental activities column, where maybe you're not including your internal service fund capital assets and you're only including governmental capital assets. So depending on which funds are getting combined or consolidated to governmental activities, you want to make sure you're kind of combining the same capital assets and debt and so forth. No consideration of unspent debt proceeds. So if you just issued a bond, you've received the proceeds in June, it's not appropriate to just include 100% of the debt and offset it against capital assets, because really none of the capital assets have been constructed yet. All of that is sitting in your restricted cash. So you have to reduce your capital debt by any unspent debt proceeds if they are significant. So if you have some spare change, you don't need to necessarily consider that. Right? Other capital related liabilities and I think this is still probably often missed, or it may be challenging to accumulate it, but you want to include other items like retention payable, other capital, outstanding accounts payable. Um, I think the challenge, retention payable may be a bit easy. Capital related accounts payable may be challenging, as you may need to do an analysis of your accounts payable to identify what's capital related and what's not. Generally, what may is AP in your capital projects fund may be an easy way to just pick that up. Otherwise, it may require you to look at it. Generally, if it's immaterial, but obviously you need to prepare some kind of analysis to determine it's immaterial and not just say it's, I think it's immaterial, I think let's move on. That's not necessarily the best response. Okay. Consideration of deferred gain or loss on refunding. Um, and that's one that a refunding debt, if the refunding debt is refunding a debt that was originally capital, the refunding debt takes on the nature of the debt that is being refunded. So if you had a debt that was issued to build a bridge and then you refunded that debt, it's the refunding debt is a capital debt as well. And the gain or loss on refunding should also be included in this calculation. You want to maybe use the GFOA calculation worksheet. It's free. It's a good memory jogger. It has all the elements you need to consider. Probably can be fine-tuned a little bit as you find necessary, but I find it a good tool to use. These are items that you shouldn't consider. So bond issuance costs, deferred inflows or outflows associated with non-capital debt. So if you have one line item for your deferred gain or loss on refunding, and it's a mixture of capital debts and non-capital debts, you want to only pick up the ones relating to capital debt. Internal borrowings, so interfund advances, those should not be considered. Also, equity interest in joint ventures should not be considered. Right. Okay. All right. Another issue that was mentioned is restricted net position categories. Maybe no restricted net position disclosed, or it's too generic, just saying restricted for special purposes, but no description of what those special purposes are. You can keep it somewhat general in the face of the financial statements, as long as you have a note disclosure that breaks down that detail, or you can have the detail on the face of the financial statements if needed. Display of long-term liabilities with no current amounts. Uh, with regards to current liabilities or amounts due within 1 year, you also want to consider pension and OPEB liabilities. That can be quite complex. I'm not going to necessarily go through each item here, but especially with you have an unfunded plan, anything that you're paying within 1 year, that would be a current liability. And this is only if you're presenting the um, the presentation that have current and non-current. It's a classified presentation, right? So if the plan is funded, then you would need to consider, are the benefit payments greater than the fiduciary net position of the plan? So as long as this would be maybe you don't have a lot of money in the plan, that would be a consideration, right? As I mentioned, unfunded plans would be an issue. Also, your long-term liabilities would include your lease liabilities and SPIDAs. Okay. All right. This is another issue. I'm not going to spend too much time. I think just consistency between the presentation of revenues on the fund statements versus the government-wide financial statements has to be consistent. If I have grant revenue in my water fund and I'm saying this grant revenue is capital related, then this grant revenue should also be reported under capital contributions or grants. I shouldn't really report it in the I shouldn't have inconsistency there. So it's just something that maybe you've set up your mapping a certain way and something has changed or you reclassified something. You just want to remember to reclassify it in both statements. Okay. And this one, I believe there is one very rare exception to the rule, but unavailable revenues are only meant for governmental funds. So you shouldn't really have unavailable revenues presented on your government-wide financial statements. Okay. Also, unavailable revenues impacts the calculation of restricted net position usually, especially if those unavailable revenues are in your special revenue funds. Right. Unearned revenues is a liability, so just make sure you don't have that in your deferred inflow of resources. Capital outlay, same like unavailable revenue, is a line item that only should exist on your fund statements. So you shouldn't have a line item in your government-wide statement of activities for capital outlay. You need to calculate a deferred gain or loss on refunding. It can be quite complex, but this is something you need to think about when you have a refunding debt. And it's something that you can probably discuss with us or your auditors, but you cannot necessarily run a difference through expense when you have a refunding debt. Essentially, the refunding debt is just supposed to replace the refunded debt, and with that would come an accounting difference. This accounting difference is going to be presented as a deferred gain or loss on refunding, and this gets amortized over time. So if you have a refunding but no deferred gain or loss on refunding, that's when they would normally identify that there's an issue. All right, moving on to the fund statements here. You want to calculate your major funds every year. So don't take it for granted that they're going to be the same every year. Also, plan to recalculate it again or recheck your calculations during the final draft of the financial statements. It can be a bit of a scary thing, especially when you have a lot of adjustments during the audit or as you're going through the financial statements and doing reclassifications. You find that actually now a fund that didn't meet the major fund criteria is now supposed to be reported as a major fund. It's not that big of a deal the other way around. So if you had determined a fund was major and it no longer meets the definition of a major fund, you can still present it as a major fund. You don't have that option if in the opposite direction, right? And there's no materiality considerations as far as major fund determinations are considered. Unfortunately, if you have it as 10.01%, which is over 10%, it's over 10%. There's no, well, it's not that material. We'll not include it. All right. And then also include deferred inflows and outflows of resources as part of this calculation. All right. All right, just moving on to some fund balance classification issues to consider. So non-spendable accounts for any items that are not really that easily convertible to cash. So usually long-term receivables, property held for resale, which that one is a question mark now. But if the proceeds, like when you do eventually collect on that long-term asset, if the monies you receive from that are restricted or committed or assigned, then you would report that asset under that category. Otherwise, they would be reported as non-spendable. I think with regards to stabilization arrangements, not a lot of disclosure there that the GFA found that are required. You can't have negative assigned fund balance. So if you have a fund that doesn't have positive fund balance, it's in a deficit, you can't present this negative amount as assigned, as there is really nothing to assign. Assign means that you have unassigned and you're assigning it to something. Okay. And then also, positive unassigned fund balance is only meant to be reported for the general fund. So only the general fund can have unassigned fund balance. Inherently, if you have monies in a capital project fund, inherently by its nature, those monies are at least assigned for a capital project. So they can't be considered to be unassigned. Unless the fund is in a deficit, then you would report this deficit in unassigned. All right. So with regards to other financing sources and uses, this is similar to non-operating revenues and expenses under GASB 103, where they are pretty rigid into what can be included here. It's not, I think this should be here, or if it's not other financing source or use, then it's going to be a revenue or expenditure or special or extraordinary item currently. So these are the items, what can be reported here. Sorry. Some labeling issues. So when you have a new debt, that should be referred to as issuance of debt, not proceeds from new debt. You would call proceeds from sale of assets, but you can't say proceeds from new debt. Your original issue or premium on those debt need to have a separate line item. Also, when you have a refunding debt, that would be a separate line item. Also, when you have a defeasance of that debt, that will also be a separate line item. Okay. These amounts should agree with the respective disclosures. So when you have your roll forward schedules, you need to reconcile that these amounts agree with what's presented in the fund statements. Okay. So special revenue funds, these are funds that account for monies that have a specific use. So they're not necessarily, they're kind of driven by if the expenditures versus the revenues themselves. So usually this is something that requires evaluation. So when you have a new fund that's created, especially when you have a new say you have a new sales tax measure and you're receiving new monies, so you establish a new fund. To determine the appropriate reporting of this fund, you need to ask the question as to whether there's any specific purpose for these monies, or are they otherwise legally available for any purpose. Okay. When you disclose information about special revenue funds, you need to disclose the purpose and also identify the specific revenue sources. Okay. All right, just go moving on to budgetary reporting. So currently, which will change, you can either report them as part of your basic financial statements or required supplementary information. General fund and major special revenue funds. So excluded here are your capital project funds and debt service funds and permanent funds. At minimum, they should be at the program or functional level of detail. This is regarding the required supplementary information. Keep in mind that if your level of budgetary control is at a greater detail than what is presented, then you need to have a supplementary schedule. Unless you also submit other report, then you need to provide a link to that other report when you submit for the award. Right? Yeah. All right. Just moving on to the proprietary funds, cash flow statements. So you have to make sure that there's consistency in how you're presenting the line items here. So your receipts from grants, for example, if you have a grant that on the income statement it's being presented as an operating grant, you can't then go on the cash flow statement and present it as a capital activity. It should be reported as non-capital activity. So just something to consider here. And then also there's only these categories, so you can't invent your own categories. You have to present them in accordance with these categories. Do not net transactions. So if a fund have transfers in and also transfers out, you would need to present both cash flow from other funds and cash flow to other funds. Don't net the two, and this is the net cash that we either received or dispersed out. Okay. If you have non-cash transactions, maybe you got into a lease. So a lease, you entered into a lease agreement. There is no impact on your cash flow statement, but that would need disclosure underneath at the bottom of your cash flow statement as a non-cash item, right? Oops. All right, and then this is just regarding a governmental debt that is to be reported with the enterprise funds. So if the proceeds of the governmental debt are going to be used by the enterprise fund, then a proportion amount of the debt should be reported with the enterprise fund. Also, if repayments are going to be made out of the enterprise fund, that's another situation where you need to record a portion of the governmental debt in the enterprise funds. It's not necessarily appropriate just to do transfers from the enterprise fund to a governmental fund and then report 100% of the debt in the governmental activities. That essentially is understating the liabilities of the enterprise fund if you've already made a commitment that 20% of a debt will be paid out of a specific fund. All right. There's some discussion here about internal service funds and something to consider. So internal service funds, a lot of them can be reporting fund deficits just by their nature, that they account for long-term liabilities. However, they're not supposed to be running in a deficit, meaning that they shouldn't really be having expenses in excess of revenues every year and running in a deficit. It's intended that over time that the revenues will equal expenses. So that's just something to consider. And sometimes you may need to record a transfer if you need to do any kind of catch-up funding there. It can be problematic. Essentially, it can hide issues in the governmental fund where in the internal service funds, that's the true expense of an activity. So your premiums that you're paying for risk management may be $5 million, but you're only charging the general fund every year $3 million. Maybe it's fine for the current year where you can survive. If you keep doing this every year, you're essentially understating expenditures for the general fund, and you're going to create an issue where the general fund now is going to run out of money, and you haven't planned accordingly. Right? So I may have already spoken in advance here, but to kind of summarize, internal service funds should break even over time. So if they're continuously running in deficits, it's something to reevaluate when you're doing your books. Moving on to the fiduciary funds regarding investments. So in your operating statement of the fiduciary funds, which is your schedule of changes in fiduciary net position, expenses should be shown separately on their own line item for investments. Income should be reported in additions, even if it's negative. So maybe because of your unrealized gain or loss journal entry, you have a negative amount here. It's still supposed to be reported as an addition. Okay. You want to evaluate these fiduciary funds. It is probably still some cleanup needed for a lot of agencies where there are probably still a lot of fiduciary funds accounting for governmental activities or programs where you have a deposit that you collect, but really the deposit is really for the operation of a government program. They are not truly being held for a third party for a service that's kind of external to your primary government. So you have to ask the question, is it really fiduciary? GFOA only can go by what's written in the note disclosures, but it's something to evaluate every year, especially if maybe you have a new fund and you're trying to ask that question. All right. So control is one of the things to ask yourself. Do you have control of those funds or not? Sometimes you don't technically have control. You can't make any decisions on those monies. So is it really fiduciary in that aspect? And also, is it really, could it be something that you're just holding as a deposit for a governmental activity for providing service? Okay. So custodial funds are not exactly the same as agency funds. They probably replaced a lot of your agency funds, but they're not the same. They do report fiduciary net position, and they'll also have a schedule of changes in fiduciary net position. So it's not going to be every single time that your assets equal liabilities and you have zero fiduciary net position. If you do have a situation like that, you want to probably evaluate it to see if that's really correct or not. All right. Moving on to the notes. Again, I mentioned no agency funds, mentioning of economic resource measurement focus, uh, no more usage of market value or fair market value. It's now referred to as fair value. Donated assets are reported at acquisition value. It's not no longer, I think the old terminology was estimated fair value. So that's old. Reference to component unit financial statements. So if you have component units and they also issue their standalone financial statements, they should be a reference that those financial statements have been issued and where can they be obtained from. Right. This is just some investment disclosures to consider and are often missing. Ratings, leveling disclosure. Common one is the valuation technique description. So there have to be some discussion as to how it was level 2 was determined, what type of fair value techniques were used. That's often missing. It's just usually a table and moving on. Donated capital assets, I think we talked about that. I think I may have just forgotten to delete that. I'm sorry. But and then also disclosure about which governmental funds have typically been used to liquidate liabilities. Actually, this one, I probably should have taken it out as it's no longer applicable this year. Right? Actually, it's probably still applicable for pension and OPEB, not for compensated absences. Debt refunding disclosures. So when you have debt refunding, there are some additional disclosures that need to be made rather than just a regular debt issuance. So you can't use your template from a debt issuance and then just use the same template for refunding debt. You need to add some additional discussion here. You need to discuss the aggregate difference in debt service between the refunding debt and also the refunded debt. And then also what was the economic gain that needs to be presented. And usually this is a number where you have had a consultant do an analysis as to what are the net present value savings of the refunding debt. And that's why you've made the decision to actually refund because there is savings there. Keep in mind, this is different from the deferred gain or loss, which is an accounting difference. So you may have a economic gain, which will always be kind of the case, but you may have an accounting loss, and that's just based on how those par values are determined based on the interest of each debt, so and also premiums and so forth. So it's not unusual that you may have an economic gain, but you have a deferred loss on refunding. Let me just make sure I have enough time. 4 or 5, so I got 10 minutes. Okay. All right, I think I have about 10 more slides left, so I think we're on track. Long-term liabilities, so some of the information to probably disclose is the purpose of the debt, unamortized gain loss on refunding, is a deferred inflow or outflow. They shouldn't no longer netted with the debt. So previously, before the implementation of deferred inflows and outflows, previously when you had a refunding gain or loss, it used to be netted with long-term liabilities. That's no longer the case. Now it should be reported separately from the debt. Revenue bonds, you want to identify the specific revenues that have been pledged and the amounts. The general purpose for the debt, the term of commitment, proportion of pledged revenues to total revenues, if it's not 100. Comparison of pledged revenues recognized during the period, and also to the debt service for the year. So it's a comparison of, well, these were the revenues for the year that were pledged. This was our annual debt service. And then you may also want to consider adding any, if you have a net revenue disclosure requirements, maybe a calculation of that as well. Segment disclosures. So this is when you have a revenue bond, especially if this information is not a major fund. So if you have an enterprise activity that have this debt and it's reported as part of your non-major enterprise funds, then you would need to include additional disclosures here of these summarized income statement and so forth of that fund. Okay. All right, just more fund balance information here. So this is required when you require a disclosure when you don't present this information on the face of the financial statements. So if you just have general line items for non-spendable, restricted, committed, assigned, and there's no detail as to what is that in those numbers, then you need to have a table that really breaks down this information. And then also you want to avoid vague or generalized terms such as restricted for special purposes. What's a special purpose is not very helpful. Um, fire-related special assessments, restricted for fire protection versus public safety is an example. We most often just work with cities, so I want to keep in mind those of you at special districts, keep in mind that when you're looking at GASB 54, it's for purposes narrower than the purpose of the government. So naturally, a fire district that receives monies, all the monies it collects is for fire purposes. Same with the city, whatever you collect of, hopefully you're not spending it for not activities that are not permitted by the city. So it's really, you have to look at purposes that are narrower. This can create some differences in your financial statements for component units. So for example, you may have a fire district that a city kind of acquired, and you may have a special revenue fund for that fire district, and it's all presented as restricted because all the monies are restricted for that fire purpose. However, if you have separately issued financial statements for the fire district, you're not going to present all of it as restricted. It's inherently understood that the monies are restricted for the fire purposes, but you then maybe want to break it down into committed, unassigned. So it won't necessarily be consistent between those two reports. Significant encumbrances need to be disclosed. With regards to interfund transactions, interfund transfers, the intent and purpose of the transfers need to be disclosed. Reimbursements are not transfers, so that's an area I think a lot of agencies need some cleanup, and it's just in the industry wide, I think it's not very consistent, but reimbursements technically are not transfers. Okay. All right. So just some pointers for capital assets. Accumulated depreciation should not exceed cost. So that's just if you have a line item equipment and you have $1 million in equipment, you shouldn't have accumulated depreciation in equipment for $1.2 million because the maximum it can be is $1 million. So it's often maybe with some kind of misclassification happened at some point, or something went wrong at some point, and that just needs to be looked out for. Similarly, when you have a deletion of an asset at the cost value shouldn't exceed, sorry, the cost should be higher than the deletion of the accumulated depreciation, right? Yeah. All right. And then also just a pointer here, if you have a lot of assets that are fully depreciated and they're not really, you're still planning to use them for long periods, maybe you want to consider reevaluating the estimated values of useful life of your capital assets. Really, it's something that it's an estimate, so and something that you can reassess every year. So it's not something that's necessarily stuck in stone. If you find that you're using your vehicles for 10 years and not 5 years because of budget constraints or something that's changed, you want to change how you account for that. All right, just some information about pension and OPEB. Oops, sorry. So with regards to pension and OPEB, some amounts need to be aggregated. So you need to have total pension expense, you need to have total OPEB expense disclosed. Um, and then also it's useful sometimes to see other totals uh, consolidated just for review purposes, not required. And then also for if you have multiple plans, these disclosures need to be, these can be different. So if you have a cost sharing plan, if you have a single employer plan, whether for pension or for OPEB, the disclosure requirements are different. So you can't necessarily copy and paste an agent multiple employer plan's disclosures for a cost sharing plan. You can't use a single employer plan for agent multiple employer plan and so forth. There may be similarities in certain cases that you can kind of consolidate, but you want to keep in mind that trusted and non-trusted disclosures will be different. Defined benefit, defined contribution will be different. Whether plans issue separate financial statements, what are the measurement dates, and so forth. So you may want to try, I know you want to try to maybe simplify this disclosure as much as possible, but keep these things in mind to make sure that you're disclosing all the required elements for pension and OPEB. All right. This is some common missing information for pension and OPEB, the type of plan, schedule of changes, details of the deferrals, whether and how to obtain separately issued financial statements of the plan, assumption information, sensitivity disclosures for discount rate and healthcare cost trend rate. So just something to keep in mind there. All right, just making sure I can kind of finish on time and not hold you guys up here. But something to keep thinking about your required supplementary information for pension and OPEB is, whether you're using covered payroll or non-covered payroll. Essentially, covered payroll is a payroll that drives the amount you contribute to the plan. So, like with CalPERS, you have based on your pensionable earnings, that's what really determines how much you contribute to the plan. With OPEB, for example, unless you have something in your policies, generally what you contribute to your OPEB trust is not really tied to what are the earnings of employees. So that's what non-covered payroll is, okay? So just some information here of when you should be using covered payroll or non-covered payroll. Also, this changes when you have a trusted versus non-trusted plan, okay? These slides will be available to everybody, so you'll have this, you don't need to memorize it or anything like that. But also the periods can be an area where you can get confused because you have schedules that kind of show you the changes from one measurement date to another measurement date. So the payroll that should be presented on that schedule really should be for that measurement period between the two dates, right? And then otherwise you have other schedules like your schedule of contributions that are present the contributions for the year. So that would be payroll, the payroll that should be presented there should be for that same period. Okay. Also common is missing assumption information when your contribution requirements are actuarially determined. So if your contribution requirement is actuarially determined, regardless of whether it's contractually required or not, you should be presenting the actuarial assumptions that went to drive the that calculation of what you needed to contribute. These assumptions may be different from the assumptions used to calculate your liability. So it is kind of confusing because especially with the agent, multiple employer plans for CalPERS, there's assumption information in there. That assumption information is for the actually determined contribution. It's not for the calculation of the liability. For the calculation of the liability, they have a separate kind of handout that they have on the website that has the assumptions for that. So they keep this in mind that the assumptions may be different when you have this schedule. Oops, sorry. All right. Also, if the plan is unfunded, it requires a statement to say that there is no funding of this plan, right? Not presenting all required years. So keep in mind that last year was, we finally got 10 years to present for a pension. So this year you would need to drop 1 year off and add 1 year. So don't present 11 years this year. There's some more information about budget. So not disclosing the budgetary basis is a common omission. Not reporting the legal level of budgetary control is required. Okay. So if you do include a supplementary budgetary schedule as supplementary information, should be, this is if your RSI is not at the legal level of budgetary control. So if you're presenting your budget to actuals at a very summarized level, but you're, in terms of legal control, it's more at the department level, then you need to have a supplementary schedule that breaks down your budget to actuals by department. And then also, if you have major funds, is that worded right? Trying to see what I reported there. Okay, I think this is just, sorry, probably it's not well labeled. I think what I meant to write here are major funds that are not special revenue funds. So if you have major capital project funds or major debt service funds, then in your supplementary information, you should include budget to actual if those funds have a legally adopted budget. And then also it's optional to include non-governmental funds here. Okay. And then just some general comments on the statistical section. So similarly, amounts not agreeing to financial statements, including debt, for example, outdated footnotes. So you may have footnotes in there discussing something that happened back in 2009, or GASB 54 was implemented in 2012. It's already out of date. It's no longer applicable to the 10 years presented. Those can be removed. If you are brand new to the ACFR scene and you're building your ACFR and you don't have 10 years of information, then you can state that 10 years of information is being accumulated, which is why you only have 3 years or 5 years or what have you. Revenue information of most significant revenue source is not reported. So if we have a touristic city and most of their revenue comes from TOTs, but in the statistical section, it's all talking about sales tax and property tax, and there's nothing discussing TOTs, that needs to be probably changed, and they probably need to incorporate some information about TOT revenue if that's their largest revenue. Okay. Net bonded debt, so amounted restricted for debt repayments shouldn't exceed the financial statement amount. So you can't have in your net bonded debt calculation, there's an amount disclosed in there restricted for debt service. So that amount shouldn't be different or be less than what you have in your financial statements, right? In the calculation of debt service ratio, use the amount that's actually being capitalized. It shouldn't be calculated using capital outlay. So capital outlay may include items that are not being capitalized or may omit some items that are being capitalized. You want to just look at your reconciliation page of your ACFR for governmental activities to the government-wide, and then just use what's actually being capitalized as part of this calculation. Schedule of direct and overlapping debt. Um, so sometimes the schedule is prepared by a consultant, and this is what you use to complete your statistical section. However, the consultant may not be aware of every single debt that you have. They would just maybe look at what's publicly available. They wouldn't maybe adjust the debt balance for any unamortized premium or discounts. So these debt amounts don't agree back to your financial statement disclosures. So you may want to review that to make sure those debt totals that apply to, that relate to your government are actually correct. And if needed, ask them to revise their schedule to include those updated amounts. Right. This is just a listing of helpful resources, and this might help you in kind of planning your ACFR or getting more information. I think that's all I have. So hopefully I've probably went a bit late, but otherwise I'm happy to answer any questions if there are any. I don't think so. Right. Thanks.
All right, good job, Nitesh. All right, well, I think we're done. So thank you everyone for joining us. I hope you enjoyed the day, and please, you can leave your evaluation forms on the table. We'll walk around and collect them. For attendees on Zoom, we will email them evaluation forms as well. If you have a parking ticket, you should let us know so we can validate it for you. If the gate was open and you didn't take a ticket, most likely they're just going to let you out with no ticket. But if you do have a ticket with you, then we can validate it for you. Reach out later with questions after you go home and you remember something that wasn't clear. Please email us. We'll be happy to discuss with you. Thank you again for joining us, and I hope you have a great afternoon. All right. Bye-bye.